Silver just got smashed 8-11% in a single session, and they're acting like it's just a normal red day. Strong jobs, no rate cuts, risk off in metals, move along. I'm OG John AG, and in this video we're going to rip that story open. Title says it all. Silver smashed 8-11% in one day. Strong jobs, no rate cuts. What they're not saying. Let's talk about what really went down. Segment 1. The crash. What actually happened? First, the raw move. Across the wires, you're seeing lines like spot silver plunged around 8.8% in a sharp sell-off. Intraday, quotes showed silver down as much as 10 to 11%, with prices smashing into the mid-70s and even flashing numbers near 74-75 on some feeds. Headlines from big outlets: gold and silver crash sharply today. Gold, silver sell-off rapidly. Reasons are unknown. So in one session, weeks of cautious grinding were wiped out. Stops were triggered. Late arriving bulls got liquidated. And the official explanation? Strong U.S. jobs data, fewer Fed rate cuts, metals sold off. That's the surface story. It's not wrong. It's just not enough. Segment 2. The strong jobs headline versus the trap. Here's how they framed it. Payrolls came in stronger than expected. Unemployment still low. Market odds of near-term rate cuts dropped. Higher for longer yields, bad for yield-less metals. Sell gold and silver. That's the simple algo logic. Good jobs, fewer cuts, stronger dollar, weaker metals. But there are a few problems. We've just seen massive backward revisions to prior year's job data. Overstatements in the hundreds of thousands to over 1 million jobs when you include benchmark revisions. The labor market strength is heavily front-loaded in the headline, but much weaker deeper in the report once you factor in part-time jobs, multiple job holders, and revised baselines. Underneath that strong jobs number, you've got rising corporate bankruptcies and consumer delinquencies, hinting at stress that doesn't show up in one headline print. So yes, the headline was strong jobs. But the system underneath is anything but strong. And that's exactly why the jobs number became the perfect excuse to run a smashdown. Segment 3. Why metals got chosen as the punching bag. Think about which asset got hit hardest on the day. Silver down 8-11%. Gold dropped, but less in percentage terms. Equities and other risk assets also saw selling, but the standout crash was in silver. Why? Silver is thinner and more volatile than gold. It carries a mix of monetary and industrial narratives. It had just come off a big run, so positioning and leverage were elevated. When you combine elevated speculative longs, a macro excuse, jobs print plus fewer cuts, and a futures market where paper contracts can be dumped rapidly, silver becomes the ideal target for a cleanout. You can trigger margin calls, flush late bulls, reset positioning ahead of the next phase, and then cover it with one line. Strong jobs, so metals fell. Segment 4. Rate cut bets. What changed and what didn't? Let's talk about the rate cut side, because that's the other half of the official story. After the jobs release, traders dialed back expectations for imminent Fed cuts. Pricing for how many cuts in 2026 shifted lower. Fewer total cuts, later start. Yields pushed up, the dollar caught a bid, and models dumped metals. That's real in the short term. If the market believes real rates will stay higher for longer, that's a headwind for non-yielding assets like gold and silver. But here's what didn't change. The total debt didn't shrink. The structural deficits didn't magically disappear. The long-term math of servicing trillions in debt at elevated rates still doesn't work. So what actually happened? The market said, maybe cuts come later. It did not say, debt is now sustainable forever. Inflation is dead. Hard assets are obsolete. Short-term rate pricing changed. The long-term trap didn't. That's the difference between trading the next week and investing for the next 3 to 5 years. Segment 5. Liquidation, not just bad fundamentals. A move of 8-11% in a single day is not just about fundamentals got slightly worse. That's positioning and liquidation. When price starts to break key supports, forced selling kicks in. Highly leveraged positions get margin called. Stops stacked below prior lows get run in a cascade. You see that in the character of the move. Sharp vertical candles, thin liquidity pockets, overshoots beyond fair value levels intraday. That's not calm repricing, that's clearing house work. And remember, this smash came after a strong run in a market where commodity funds had increased allocations. Retail interest in silver had ticked up. Flushes like this don't just happen. They happen when too many people got on the same side of the boat and someone rocked it. Segment 6. What they're not saying about the macro backdrop. While they blame the crash on strong jobs, no cuts, they skip the broader stress picture. Corporate bankruptcies have been climbing, with recent weeks seeing numbers at or near post-COVID highs. Consumer debt delinquencies have risen to their highest levels in around 8 years. roughly 4 to 5% of outstanding household debt. Government borrowing continues at a massive pace, with interest expense eating into budgets. Does that backdrop sound like a safe, steady system forever? Or does it sound like a system that can't carry high rates indefinitely? If the jobs number really were a sign of invincible strength, you wouldn't see such persistent stress in credit, defaults, and household finances at the same time. What they're not saying is the same forces that justify fewer cuts today are the ones that will force easier policy later. And when that shift comes, metals don't ask permission. They reprice hard. Segment 7. Where this leaves silver. End of the bull or engineered shakeout? Now the key question. John, does this 8-11% smash mean the silver bull is over? Look at the structure. Silver had rallied massively off its lows over the last year. Sentiment had improved but hadn't yet gone full mania. We were in that tricky mid-cycle zone. Big gains behind us, big macro risks still ahead. What this crash did, it scared away weak hands. It gave late entrants a painful lesson. It handed patient buyers a chance to re-enter or add at a discount. A single violent day does not erase. 6 straight years of structural deficits in silver supply that analysts have highlighted. Ongoing industrial demand from solar, electronics, and electrification. Rising global uncertainty, de-dollarization trends, and central bank diversification into metals. If anything, it shows exactly why. You can't go all in at high prices with no plan. You also can't call a long-term bull dead because of one engineered blow-off to the downside. This looks far more like a shakeout than a verdict. Segment 8. How a serious silver investor reacts to this kind of smash. So what do you do with this? If you're serious, you don't. Panic sell into a scripted smash. Double down with max leverage just because it's cheaper. You. Zoom out. Check the weekly and monthly chart. Where is price relative to last year's lows and the broader uptrend? Respect the volatility silver can move 8-11% in a day. That's now proven again. That means position sizes must be built for that volatility. Use a stage plan. Predefine zones where you're willing to add, not just react emotionally. Keep dry powder. One smash doesn't mean it can't go lower first. Separate timeframes. Traders will care about whether support holds tomorrow. Investors care about whether the macro case for metals looks stronger or weaker 2 and 3 years from now after this move. Short answer. If the underlying reasons you liked silver were Fed trapped, debt unsustainable, structural deficits, geopolitical risk, none of those got fixed by one jobs print and one smash down. In that sense, the long-term story didn't get worse. The entry prices just did. Segment 9. What to watch next. Instead of staring at the last candle, here's what to watch now. Follow through. Does silver keep bleeding lower in big volume, or does selling pressure fade and volume dry up? Strong follow through, shyness, more caution. Weak follow through and quick stabilization. Classic liquidation event, rates and the dollar. Do yields keep grinding up, or do they stall, roll over, despite the strong jobs story? Does the dollar hold its bounce or give it back? That tells you whether the rate cut narrative really changed or just flinched. Positioning data. In the weeks ahead, CFTC positioning and ETF flows will show if big money actually bailed on silver, or if some of them use this as a chance to accumulate. Macro headlines. Watch for more revisions, more cracks in employment data, more bankruptcies, more debt ceiling and deficit drama. All of that feeds back into the same long-term question. Can this system carry on without easier money later? If the answer is no, even later, then this smash is a chapter, not the story. Closing. What they're not saying. They're telling you silver crashed because jobs were strong and rate cuts are delayed. What they're not saying is the system behind those numbers is under strain. The long-term math still points to more money creation, not less. The same stress that smashed silver 8-11% in one day is the stress that will eventually push it far higher in nominal terms. You've been watching John AG here, and I'm OG John AG. If this helped you see beyond red candle, bad metal, hit like so this kind of breakdown doesn't get buried under noise. Smash subscribe and turn on all notifications. We're tracking every major move in silver, from Fed traps to money flows to paper squeezes. And drop a comment, smash or setup. Tell me if you see this as the end of the story or the setup for the next big move, and why.